Okay, this is Eric with Low VA Rates, and today we're going to talk about whether or not the VA funding fee makes VA loans more expensive than conventional loans. I'm going to throw that up here right now before I forget. VA versus conventional. And what we're talking about today is which one, or is the VA loan, because of the funding fee, more expensive or not? We're going to get into that. So while the funding fee is unique to VA loans, it is a myth that it makes getting a VA loan more expensive when compared to other loan options. So let's take a minute. I'm going to break this down with you on why this myth is, well, simply put, a myth, and it is not true. If you didn't know, every single Friday here at Low VA Rates, I wear red. And it's not just something I do, but if I were to walk out of my office right now, take the camera, you'd see a whole sea of red, because you guys mean a ton to us, you veterans. Anybody that loves this great country, has served, is serving. This is our way of every single Friday letting everybody know. I've been at the grocery store and I've had people say, oh, hey, thanks for wearing red. I've had people say, hey, what's Red Friday mean? It's a way to strike up a conversation that here's what it means. We love our veterans. Thank you for serving. So speaking of red, before I forget, down to the right bottom portion of your screen, there's probably a link that says subscribe. That's specifically for YouTube. I want you guys to subscribe to our YouTube page. Every time one of these videos goes live, you'll get a notification. Or maybe you'll see us on Facebook or somewhere else. But just the more you follow along, the better off you're going to be and the smarter you're going to be when it comes to VA loans. So wear red, watch these videos, all is good. We're going to talk right now about what the VA funding fee is. Okay, now if you've never heard of the VA funding fee, I'm going to introduce that as simply and as quickly as I can. Basically, if a veteran ends up defaulting on their VA loan, then the VA uses the money that they collected each time someone pays this funding fee to make good on the VA's 25% guarantee to the lender. So we are a lender here at Low VA Rates. We make VA loans. Those that pay the funding fee, it goes not to us, it goes to the VA. And they sit there on that kind of as an insurance policy to help in the event that there's a default. They're able to help the lender recover potentially some pretty large losses. And it's because of this guarantee that VA loans are so great for you veterans. Lower rates, looser terms. It's because of this funding fee and the money that backs the loan that it makes it so good. So not only are you helping yourself by paying it, by getting this amazing loan that we always talk about, but you're also helping your brothers and sisters in arms who might come up upon hard times in the future when they have their VA loan. Now, you also help keep the VA loan program alive for future generations of service members and veterans. Second, the actual cost of the funding fee isn't actually that much. For most of you who are using your VA loan for the first time, the funding fee is 2.3%. Okay, that's not a whole lot when you consider all of the benefits you get out of the VA loan program. Now, if you've ever used your VA benefits before, this funding fee could go as high as 3.6%. And I'm not talking interest rates. I'm talking about of your loan amount. So on a $100,000 loan, if you're at 3.6%, that would be a $3,600 fee. If it was what would I say, 2.4%, it would be actually I said a 2.3%. See, these funding fees have changed over the years. It's 2.3% if it's your first time use. That would be $2,300 on a $100,000 purchase price. So, however, it can be as low as 0.5% on a streamline or an IRRL. And for those of you that have an exemption, means that you do not pay a funding fee ever because of a VA disability rating that you have, it is zero, okay? There is no funding fee. Now, on other loan types, the most comparable thing to the VA funding fee would be over here, mortgage insurance. That's something that you've probably heard when you're talking about non-VA loans. Conventional loans, FHA loans, and USDA loans all have some sort of mortgage insurance that you're going to be charged. It's going to be charged upfront at the time of closing, and it's going to be a recurring fee that often gets paid as part of your monthly mortgage payment. So as I just mentioned, some loans like FHA and USDA are going to charge a mortgage insurance premium up front and also monthly. Conventional loans do not have an upfront mortgage insurance, but they do have a monthly mortgage insurance cost. Now, because it's charged each year through a monthly installment along with your mortgage payment, those fees can add up. And over time, they will amount to much more than that one-time 2.3% or up to 3.6% VA funding fee. So I want to break this down and make it a bit more clear if I can. We're going to dive into an example where we compare the cost of a conventional loan's PMI or mortgage insurance, private mortgage insurance, to the VA's funding fee. So I'm going to erase some of this stuff so I don't have to bend way down and I can be a bit more clear with you guys. For starters, it's important to know that PMI doesn't have set percentages. It's not cut and dry like VA loans. It gets calculated based on a variety of factors, including your loan amount, your debt to income ratio, your credit score, your down payment. So it's not as simple as saying, here's a conventional mortgage insurance table. It's not like that. However, on average, it can range anywhere from 0.5 to 2% of the original loan amount, though sometimes we've seen it get even as high as 5%. So I'm going to put over here conventional. Okay, we're going to start there. We're talking about PMI, basically your mortgage insurance. It's going to be somewhere between 2 to 5% in most cases. And I'm talking of, we'll get to the math here in a second. So to start the comparison, let's first lay out some baseline numbers. Using a real loan as our starting point. Now, when I say a real loan, this is for illustration purposes only. This is an example. So let's just say that you're purchasing a home for $425,000. Okay? That's the purchase price. Nice, beautiful home. For the conventional loan, let's just say the borrower put $25,000 down as a down payment. So what they're borrowing is $400,000. We'll put the loan amount on this conventional loan is $400,000 because they put $25,000 down as a down payment. Now I'm gonna go way low, even though this is kind of a pretty fair range. Let's just say that the PMI is gonna be charged in this example at a rate of just 0.5%, 0.5%. For the VA loan, let's assume the borrower didn't make a down payment, so they're financing the full $425,000. Kind of backwards here because it doesn't matter. Well, we'll go right here. The VA loan, they're actually borrowing the full $425,000. That's the loan amount because they're not putting any money down. And they've never used their VA benefits before, so their funding fee is substantially higher than this 0.5. It's 2.3%. Now we're going to do some math on the conventional loan. To start the PMI payment, okay, because it's not charged up front on a conventional loan, the payment monthly ends up being 0.5% of the $400,000 loan amount, which is roughly $2,000 per year, divided by 12 gives you $166 a month on average is what the mortgage insurance on this conventional loan is going to be. That's not going to change. Now, for ease of calculation, let's assume the home's value doesn't appreciate or depreciate, it just stays constant. Now, since mortgage insurance has to be paid until you've got 20% equity in your home or an 80% loan to value ratio has been reached, this means they could stop paying their mortgage insurance once the loan balance reaches $340,000. So this all goes away when the balance goes down to $340,000. That's why I said for illustration purposes, there's no appreciation, there's no depreciation. We're just talking about paying the loan amount down. Using an online amortization calculator, we determined this would take about 75 months. Okay? So if you're paying $166 per month for 75 months, that ends up being $12,450. That's a big number. $12,450 is what you're paying, not to the VA, not towards your balance, not to your HOA. It's going straight into the mortgage insurance provider's pocket. That's where it's going. Now let's look at the VA funding fee and the numbers that come with that. I mentioned a 2.3% one-time funding fee up front on the full $425,000 that you're borrowing. That's much more simple. It's $9,775. Yes, I prepared for this up front. I can't do math that fast. That's what your upfront funding fee is going to be. You get to add that into your loan. It's not money that has to come out of your pocket. It just gets added to your loan amount of $425,000. So this could end up saving the veteran not just $166 a month, but up to $2,600. That's the difference between this $9,775 and this $12,450 is an additional $2,600 that you're not just putting into somebody else's pocket. Even if the borrower, that's you, the veteran, who uses the VA loan, decides to finance that funding fee, like I said, into the loan, bringing the total amount up from the $425,000 to about $435,000, the veteran's still going to end up paying less money with the funding fee added in than they would if they had paid the $166 a month in PMI. So there you have it. It's proof that even though the funding fee is usually higher than your mortgage insurance percentage rate, you will still likely end up paying less over time with the VA loan than you would if you went conventional. And I didn't even talk about, do you have the money for down payments and everything else? That's all in other videos that we've got out there on our YouTube channel. Now, that our example is out of the way, let's talk about some of the other benefits the funding fee has over mortgage insurance, just beyond what it's going to cost you for closing costs. For starters, like I mentioned, it's possible to qualify for a waiver of the funding fee if you meet certain conditions, primarily VA disability. There are some others, but let's just talk, primarily VA disability. If you want more information on what these conditions are and how the funding fee exemptions work, there's a link below in the description box where you can get into much more detail. Another benefit is that you can actually finance your funding fee, as I just mentioned, into your loan. So you're not having to bring your checkbook to the closing table and come up with, $9,000 right out of your bank account. Just be aware that by doing that means you do pay a little bit more interest over the life of the loan by having borrowed your funding fee as opposed to paid it out of pocket. That's it. The funding fee absolutely does not make your VA loan more expensive than other loan types. It simply allows you to have all these incredible terms that come with VA loans. It helps keep the program running and alive, and it will almost always cost less than a mortgage insurance on other loans. If you want to talk to one of our licensed loan officers in more detail about the funding fee, how it works, go ahead and pick up the phone, give us a call, chat with us online, reach out. I'm not personally licensed, so you're not going to be talking to me about your specific details, but we've got an incredible team here at Low VA Rates that's always willing and happy to answer your questions. Thanks for watching. We'll see you next week at the same time.